So this is going to be a raw video of me breaking down the exact strategy that scaled me to millions of dollars and I generate thousands of dollars every single month with stock options. It's not just me that uses this strategy. There's hundreds of other people just like you that are using this strategy in their portfolios right now, and they're scaling right now too. So it's not like I got lucky. I had no unfair advantage that you don't have. Everybody can do this and everybody can implement this into their portfolio right now. So this video is not going to be all fancy. There's not going to be a bunch of edits, not going to be things popping up all over the place. It's just a conversation between me and you of exactly how to do this strategy, how to implement it in your portfolio right now, and how to scale to true financial freedom, how to scale to millions of dollars. I've done it, others have done it, and you could do it too. So if you stick around until the end and you understand the entire strategy of what I do here, you will be able to implement this right now in your portfolio with no questions asked of what to do. So here we go. So to start off, it's critical to keep things extremely simple. There's no need to complicate investing. There's so many people that overcomplicate it. We're not going to do that here. My strategy, I could explain it to a 12-year-old of exactly how to do it, how to implement it, and how to understand when to buy, when to sell, and what strategy to use. It's very, very simple once you understand it. So we're going to break this down into 3 different parts, and we're just going to go straight into it because I don't want to waste your time. I know there's a lot of other YouTube videos that you probably want to watch, but I promise you, if you stay till the end, this will be hands down one of the most important videos that you're ever going to watch, because when I had this idea, when it first clicked for me years ago, when I watched that YouTube video of how Warren Buffett did stock options, I was like, oh my God, why didn't I ever think of this before? This is massive. So just stick around until the end. So everybody wants to make money with stock options, and I get it. They're sexy. You could double your money overnight. You see all the headlines of people that made a crap ton of money doing it. But unfortunately, you don't see all the headlines of people that lost a bunch of money doing it. Everyone on Twitter, everyone on YouTube, everybody on X, they just show you the glory shots of their portfolios. They just show you the winners that they have in there, but they don't show you all the losers that they have that got them to that point right there. So what I'm about to say right now, you're going to be like, what the heck, Brandon? I already know that. Everybody knows how to do that in the stock market. What value are you giving us right now? And it's not going to click until the end of the video, I promise you. I'm not trying to get you to watch till the end, but just stick around. I'm really stressing this. I never beg people to stay till the end of a video, but this one, you have to understand this stuff first. So part number 1 of the strategy, you need to build your base portfolio. So I recommend you buy 40% of your portfolio in VOO, which is the S&P 500, 40% in Triple Q, which is the NASDAQ, the ticker's QQQ, and 20% in individual companies. So that setup right there, we're going to call that the base portfolio, and that is part number 1. So if you have $100,000, put $40,000 in a VOO, $40,000 in a Triple Q, and $20,000 into individual companies. And this base portfolio is critical for stock options. We're going to come back to this in a second for part 3. But understand this. The base portfolio, if you allocate like that, you are simply going to outperform over 95% of hedge funds, of financial pros, financial advisors, anybody that you think is smoking the market. They're not. 95% of people are not going to outperform the portfolio that I just laid out there after fees are included in the long run. In a short-term basis, maybe a 1, 2, 3-year time period, there will be people that will outperform this portfolio because they simply just got lucky. They bought Palantir before it started going up. They bought NVIDIA. But again, you're trying to find needles in a haystack, and not many people are good enough at doing that. So right now, I feel like the S&P and the NASDAQ are roughly 10 to 15% overvalued. You're going to say, Brandon, do I build a base portfolio right now? And I'm going to say the answer is yes, as long as you are okay being invested for at least 5 years in your base portfolio. If you're not willing to be invested for 5 years at a minimum, do not build your base portfolio, because let's say you have $100,000, but you plan to buy a house in 2 years and you need that money for a down payment. That $100,000 might be less than $100K in 2 years because the market's a little bit expensive right now. Maybe we dip down and it doesn't recover back to $100K in 2 years. So you have to understand your time horizon before you put money into the stock market. And you're probably wondering, if the stock market completely moons and it goes way up, at what point do we say the S&P and the NASDAQ are too expensive to buy? And what I talk about in Discord, and it's free to join below if you want to get in, what I talk about in there is if the S&P and the NASDAQ get over 20% overvalued, so 20% expensive, that's why I recommend to lay low on the sidelines and not buy shares in a base portfolio. You could buy bonds, you could buy CDs, you could do whatever you want, but I just recommend to lay low and not put a lot of money in the market at that time. because the chance of having a decline and a dip is very, very high. So right now, like I said, we're 10 to 15% overvalued. So we're not there yet, but we're very, very close. So that's why it's critical to understand how to value the overall market. And remember when I explained to you that the base portfolio is so critical, it's because you cannot do stock options the right way unless you have this base portfolio built, which again, we'll get into that in just a second. Part number two is how do we allocate the 20%, the 40, 40, 20? How do we allocate the 20% of the individual companies? And this is what I say. Don't just take your 100 grand and buy $20,000 worth of Tesla. Don't buy 20 grand worth of Palantir. Only buy companies when they're trading below intrinsic value, which intrinsic value is just the true value. They have to have a moat, which is basically like pricing power, meaning like does Apple have a moat? If they want to raise the price on an iPhone by, double the price, are most people still going to buy iPhones? The answer is going to be yes. But if you double the price of this battery right here, are people still going to buy this battery? Well, maybe not. They might just go with the competition. But Apple honestly doesn't have that much competition. So they have a moat, they have pricing power, and they have a durable competitive advantage. There's not much competition. Batteries are a dime a dozen. There's so many people that make batteries. There's a lot of competition with regards to that. So you want to buy companies that fall into those categories right there. And I understand that sounds very simple to do. Buy cheap companies that have pricing power. We get it. But the hard part is how do we value these companies? And that's what we'll get into in just a minute. But when you buy individual stocks, you have to understand how to spot good companies at a good price. So it's critical to understand that a great company is not always a great investment. And to be honest with you, great companies usually aren't great investments because they're usually trading at expensive valuation levels. So the key here is to buy a great company, but at a good price. We don't need to get an immaculate price. We don't need a perfect price. We just need a great company at a good price. You don't want to buy a great company at an astronomical price because a lot of the future growth is already priced into that stock. And even though it's a great company, you might not capture a lot of upside growth going forward because it's already realized in the current stock price. Now, part three is where we bring everything together, and this is the whale in the room, and this is going to be stock options. And this is how I consistently generate thousands of dollars pretty much every single month with stock options. But I don't do stock options how you think. The majority of the options that I do, I sell stock options. I'm not usually a stock option buyer. And the reason why the base portfolio matters so much is because when I sell put options and when I sell call options, I use my base portfolio as collateral. So a lot of people say, I want to sell cash secured puts. And I'm like, that makes absolutely no sense because why would you want to have cash sitting on the sidelines if you're selling put options? Because selling put options is a bullish strategy. Like if you sell a put, you need the stock to go up, stay flat, or just not go down to the strike price and you make money. So if you think that a stock is going to go up, if you think a stock is cheap, if you think it's going to be great going forward, why would you not want to own those shares also at the same time? Of course I do, and that's what I do in my portfolio. So let me just explain super quick what selling puts are and how I look at this because, not people look at stock options this way, but this is actually how they work. For every transaction, there's a buyer and a seller. So when someone buys a put option, there's someone selling them that put option. So when someone buys a put option, what are they trying to do? They're buying downside protection in their portfolio because buying a put option allows them to sell their shares at a certain price in a certain time frame. So typically when there's a lot of demand to buy put options is when stocks are falling. And guess what happens when stocks are falling? Everybody's freaking out, the sentiment is very low, and there's more demand to go buy put options. And when there's more demand to go buy those put options, that pushes up the put option premiums. So not only am I capitalizing on stocks going down and selling puts when these companies are cheap, which I'm implying they're going to go up soon after I sell these puts because they're already cheap and they're beat down in price, but emotional investors are paying way more for them put options than what they're actually worth. So when I sell them those puts, they're buying those puts from me at a time that the stock fell, which means it's cheaper, which means it's safer, which means it's probably going to rebound in the near-term future, and they're very emotional about it, so they're willing to pay pretty much anything for those put options. So that's where I swoop in, and hundreds of other people swoop in that know my system also. We swoop in when things are beat down in price, and we sell put options. But the critical part about selling put options is we're not selling these put options with collateral of cash. We're selling these put options with the collateral of our base portfolio. Because think about it, cash is cash and we understand that, but my base portfolio has value. So let's just say that I sell these put options and the stock continues to fall and then I go in the money and I'm forced to buy these shares. Because remember, the person on the other side of the trade, they're buying the put option from us, and that's allowing them to sell their shares at a certain price in a certain time. So let's say that the shares do fall, that option contract go into the money, and I'm forced to buy those shares. That's okay because we have the base portfolio as collateral. So in a worst case scenario, we could sell shares of the base portfolio, generate cash, and then take assignment of those shares. Now, if you don't want to sell your base portfolio, you could close out the contract at a loss, or you could take assignment on margin, which of course is a scenario that you could use. And sometimes when I go in the money on puts, I will take assignment on margin because think about it. Most people freak out when they get assigned shares when you sell puts, but understand what's going on right here. If you sold a put when you felt like the stock was already cheap and you feel like they have a moat, they have a pricing power, they have a durable competitive advantage. If we sell, for example, a 6-month put, why would you not want to buy the shares 6 months from right now, get paid to do it, and buy them at a cheaper price than what they're currently trading at right now? Because let's just use an example like company XYZ. If the current price is $100 a share right now, $100 per share, and I feel like it's cheap right now, do we think that the share price is probably going to be higher a year from right now or even 6 months from right now? The answer is probably going to be yes. So maybe we think the share price is going to be $120 per share. So why not go sell an $80 put? So in the event that it goes down to $80, we're totally fine taking assignment of those shares for $80 per share because we could take assignment and then we could do the wheel strategy where once we take assignment, we just sell cover calls on that and we just repeat the cycle over and over and over again. But I will say this, I've been selling put options for probably 7 years now through bull markets, through bear markets. I've been through a lot of markets, a lot of volatility. This worked through COVID. This worked through 2022. This worked for the tariff stuff that we just got. If you do it right and you understand how to value companies and how to value the market, your chance of being assigned shares is extremely low. But again, we don't care if we get assigned shares when we sell put options because we have a plan in the event that that happens. We take assignment of shares on margin, we sell the base portfolio and take assignment with cash, or we close out the contract at a loss. But it's very unlikely that I'm going to close out the contract at a loss because these shares are cheap and the likelihood that they're going to rebound is going to be very, very high. On top of that, which I'm not going to go into pretty deep in this video, but it's another thing to think about, you could roll these contracts. So I could essentially buy more time in my contract. So let's say my contract expires today, but I'm in the money a little bit. I could roll it. So I could basically buy the contract back and then sell another one 6 months out from right now or whatever date I want to do. And I'm allowing more time for that stock price to rebound. And my chance of actually getting assigned these shares and losing money is extremely, extremely low. Now, to bring this back together and try to make it click in your head of why selling puts is so good. So it's critical to stay around here. I really want this to really make sense for you guys. What does every single CEO want? Like think in your head right now, what does every single CEO of every single company want to do? They want to make their companies more profitable. They want more revenue, more earnings per share, more efficiency, better products, just push their company more into the future. When they raise earnings per share, what does that do for the stock price? Stock price goes up because as you guys know by following this channel, I talk about it time and time again. The number one thing that moves the price of stocks in the long run is what the earnings per share of these companies do. So as everybody on the board, all the CEOs, they want their share prices to go up. You are on the winning side of that trade. Yeah, short-term stocks are very volatile, but in the long run, they will trend up for the most part. As long as you get in at a good price, they have a moat, they have pricing power, they have a durable competitive advantage. The longer that you hold them for, the more likely and the more time that you're going to give these CEOs to make the share price go up. If you go to Elon right now and say, hey, I need you to make Tesla more valuable in a week, he's going to say, I can't do it in a week. But if you say, hey, Elon, can you make Tesla more valuable in 1 year? He's going to say, probably. So that's why I like to sell usually 1 year duration when I sell puts versus 1 month, because you're getting that tailwind of the earnings per share and revenue going up, and you're having more likelihood that those contracts are going to expire out of the money. And I want to go one step further real quick because I know that you're probably thinking this, and if you're not thinking it right now, you will be down the road. Brandon, why don't I just sell monthly put options and I do 12 trades per year and you're only going to do 1 trade per year? So it's like I can make cash flow every single month if I do 1 per month. But Brandon, who only does 1 per year, he's only going to make money once per year. 100% incorrect and false. Think about this with me real quick. If you sell monthly put options, in order for you to make a similar amount of money as me, you have to hit almost 12 of those in a row. You have to sell a put, it expire worthless month 1. Then month 2, you sell a put, expires worthless. Month 3, you sell a put, expires worthless. You have to be able to hit 12 months in a row to make as much money as I'm going to make by selling a put on January and selling a put in June. So basically just selling 2 puts per year. I will make more money than you only having to make 2 trades and you're going to have to make 12 trades. I only have to hit 2 trades in a row so I could be way more selective, way more precise on exactly when I want to strike, when the stocks are beat down in price. So my strategy by doing this on a yearly basis versus a monthly basis, it's 10 times easier, 10 times more sustainable, and in the long run, I'm going to make way more cash flow than you. Yes, I get it. My cash flow is going to be a little bit more lumpy than yours. Some months I might make $50,000, some months I might make $0,000, but at the end of the day, when we add it all up, if I try to do this strategy on a monthly basis versus an annual basis, I will make a lot more money than you. And also understand this, when you do this on a monthly basis, you're going to try to force trades when they're not actually there. You're going to sell puts when things are going up in price and you don't want to miss out on any future upside that you might get. You're going to get a little bit of FOMO. But when I do this, I'm not going to get FOMO. I'm going to strike when it makes sense. And when it doesn't make sense, I'm just going to do nothing. And to be completely honest with you, there's not always opportunity in the market. When the market gets volatile, people freak out, people sell their stocks. That is where the opportunity is at. So maybe let's just say you make $10,000 per month selling puts on a monthly basis if you do 12 in a row. So you make $120,000 in a year, which, whatever. But if I had the same size portfolio, maybe you make $120,000 because you're so good and you can nail 12 trades in a row, which I bet that you can't. But for me, maybe one month I sell $60,000 worth of puts when the stocks are cheap. And then another month I sell $100,000 worth of puts when the stock is cheap. So I'm going to make $160,000. You're going to make 120, and I sold at a better time and only have to make it on 2 different trades. I'm way more precise, way safer, and it's just a better time to get into those trades. To bring this all back together and why the base portfolio matters so much. The base portfolio is honestly everything because stock options are not the primary strategy. The primary strategy is building the base portfolio. So how do we build the base portfolio? We sell put options, we take the cash that we get credited to our account immediately, and then we go buy shares in the base portfolio. And the benefit of selling longer duration puts when you feel like something is cheap is this. Let's say arbitrary numbers, you sell a put option on a 1 month basis and you collect $2,000. You have $2,000 that gets credited to your account immediately in a cash balance. Great, we understand that. So now what are you gonna do with that $2,000? You could go buy shares of VOO and what do you get, like 4 shares right now? They're like over $500 a share. You feel smart because you sold the put, things are cheap, you got, 4 free shares of VOO. Yes, you did okay, but think about it this way. You collected $2,000 on a 1 month put, but what if I sold a 2 year put and collected $30,000 instead of $2,000? And now, when the market is cheap, I have $30,000 to work with, not just $2,000. So I could take that $30,000, I could buy way more shares, I could buy more call options, I could do whatever I want to do. I'm just capitalizing more when the opportunity is there. So the thing about it is, people just don't understand that opportunity is not always there. But when opportunity is there, you have to strike and you have to strike very hard. So I am patient. There's sometimes where I don't make a trade for a month, but there's also times where I make 25 trades in a month. It all just depends on what's going on in the market right now. I made a couple trades today. I made a couple trades a few days ago. There is some opportunity right now, but you just have to be very, very careful and very, very selective. And to finish up, I'm going to say this. I'm in my lower 30s right now. I know there's going to be people that talk crap on here and say, you've never been through a bear market. You've never been through a recession. I have. I've been through COVID. I've been through 2022. I've been through the Japan carry trade. I've been through the tariff stuff. There's been a lot of volatility in the market. I've been through it. It's fine. Now, how I'm leveraged in my portfolio right now is relatively minimal leverage because I feel like the market is a little bit expensive. So I don't like to sell puts when things are expensive. Remember, I like to sell puts when things are cheap. So I have a lot of margin buying power on the sidelines right now. So if the market dips, I'm going to capitalize on it. But if the market doesn't dip, I have my big base portfolio. I have millions of dollars in my base portfolio. And I have sold puts right now on AMD, sold puts on NVIDIA, sold puts on TSM, sold puts on Meta. So I'm capitalized to capture some upside right here, but at the same time, if we get downside, I'm going to be fine. And one more side note to add on because I wanted to say this to the end, and really the people that made it this far, you're probably going to be the people that are going to succeed doing this strategy. And this is like the light bulb moment. I could use that base portfolio as collateral to sell puts. And when I sell these put options, I'm essentially getting a free loan from myself. But when I'm doing that loan, I am not paying a penny in margin interest. I am not actively on margin. I am just using my margin buying power to secure the trade. So I'm basically just getting access to my money for free. So why not do this? Why not sell puts when things are cheap? Take the capital, roll it in the base portfolio, and you'll grow so much faster. So I hope that this video helped you guys out. There's so much more detail that I could go into. And to be honest with you, if you are interested in this stuff, if you really want to scale your portfolio, if you don't want to waste 10 years of your life trying to go through all the hard stuff that I went through, all the mistakes, all the lost money, all the lost time, you can learn the ins and outs of this strategy step by step to the T in a 10-hour course that I made, and you could get it all below for 100% free. And on top of that, you could get into my Discord, which is 100% free also, but it's not going to be free forever. So if you want to get in, lock it in, learn my strategy. This is one of the hands down best times to educate yourself in the entire time of the world, because we're on the brink of a massive tech and AI revolution right now that you have to understand how to capitalize on it.